Hello, in this presentation, we will be entering and adjusting entry related to depreciation into our bookkeeping problem in Excel, keeping in mind how this same information might be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We're first going to take a quick look at QuickBooks and then jump over to Excel and enter the data there. When considering depreciation, we're taking a look at the property, plant, and equipment, which QuickBooks will call fixed assets. We could also call it depreciable assets. We're talking about those long-term assets that will be depreciated or go down in value over time, and where we will need some type of estimate in order to decrease those in value. You can see here's our balance sheet, and we have our groupings of current assets, other current assets, and we have our fixed assets. We're talking about the furniture and fixtures. Those are the things that we will be depreciating. Unlike something like supplies or as we looked at prepaid insurance, where we can actually see or calculate exactly how much of that has been decreased, and therefore it makes sense for us to allocate the adjustment directly to the prepaid insurance. Furniture and fixtures, something if we're talking about a couch or something like that, it's not very easy for us later on. We can't say that there's less couchness. It's still the same couch, even if it went down in value. We know if it was something like an automobile, that as soon as we drive it off the lot, that it's supposed to decline in value, even though it's the same automobile. So therefore, we know that this is going to be some type of estimate. And because it's an estimate, we're going to create some other accounts and not be writing down the furniture and fixture or depreciable assets directly, but creating a contra asset account, that contra asset called accumulated depreciation. The expense side also not being called fixed asset expense or furniture and fixture expense, but being called depreciation expense. So that's going to be the journal entry. We'll debit depreciation expense related to, in this case, furniture and fixture, and we will credit accumulated depreciation. We don't see accumulated depreciation yet if we were considering QuickBooks, because it's zero, so there's nothing there yet, and therefore the account isn't there. When doing adjusting entries in QuickBooks in just about any system, we typically would use a general journal and put this information into a general journal using debits and credits. However, it is possible to use a register format in order to enter this data into something like QuickBooks. In Excel, as we will do now, we will be using debits and credits to record the adjusting entry. Here we are in Excel. We're going to be using the Adjusting Entries tab here to record our depreciation. The depreciation, like most adjusting entries, will follow the standard rules, and those include the fact that cash will not be affected. We typically have one account on the balance sheet side above the equity accounts and one below on the income statement side, and it's going to have something to do with depreciation in it. So if we go through the accounts and look for something with depreciation, we can see accumulated depreciation up top here. So I'm going to go ahead and highlight this little area yellow to say that's one account we will be dealing with. And if we look at all the accounts on the income statement below the equity section, revenue and expense accounts, that is, we see depreciation expense here. So I'm going to highlight that yellow as well to note that that will be something we will be working with. So even without really understanding, like with most of these adjusting entries, we can find, if we have the trial balance, what the two accounts will be by applying those rules. We're not doing anything to cash. The expenses typically go up, and the other account is going to have a balance sheet account and be something with the name of what we're working with, in this case depreciation in it. We also know which way it's going to go because we know that the income statement accounts, like this account, only go one way. They go up. Expenses go up in the debit direction. So this being a expense account, it's going to go up in the debit direction. So we'll put that on the top of our journal entry. So we're going to copy that in K26, right click and copy. We're going to make our new entry in A22, and like all entries, it's going to be as of the end of the month. 2/28 is the date. We're going to put the depreciation expense up top, right clicking and pasting 1, 2, 3. And then that means that the other side is going to be the credit. Here it is, accumulated depreciation. That's what the credit will then be. We're going to copy the accumulated depreciation, put that on the bottom. We are in B23, right click and paste 1, 2, 3. Then we're going to go and indent. So I'm going to go to the Home tab, Alignment, and increase the indentation, and there we have it. So we can do all that without really understanding what we're doing here. Let's take a quick look once again at what we are doing. We are considering the furniture and fixture that we have purchased, and we're trying to see that it has decreased in value rather than writing down the furniture and fixture directly, which would make the most sense. We make another account. It would make sense in that it would tell us exactly what we are doing. It would be easy for us to see exactly what is happening. But in order for us to recognize and tell our reader that this is an estimate, that we don't know how much it exactly went down by, but we do want to recognize the fact that it did go down, we're in essence going to pull the credit half of this account out. This is the debit half. We're going to say we're going to create a credit account, which is really related to directly this account, and show you the decrease that we estimate it to be, and then you'll have to subtract those two out to get the net value. And then we'll record the other side not as furniture and fixture expense, but as depreciation expense on these long-term assets so that you can recognize that it is just an estimate. A couple ways that we can get this estimate. I'm just going to do a quick type of calculation to get the depreciation estimate here, and just to get an idea of what this type of calculation would be. This is a form of straight line calculation. We're going to take the amount, 103,000. Note that we're just going to take the whole thing and depreciate it as if it were just one piece of equipment. In real life, we would have to take each piece of equipment and go through a schedule to depreciate each piece of equipment, and it could be a fairly tedious task, especially if we have different depreciation for tax purposes as well as book purposes and so on and so forth. But the concept all comes down to a straight line method, and then there's variations from that. So we'll just take the 103,000. We're going to subtract the salvage value, which we're going to say is 10,000. That's what we think that we are going to be able to scrap this for at the end of its useful life. So after it's used up, we still think it's going to have worth of 10,000 that we can get. That gives us the depreciable amount, what we expect to decline and depreciate over its useful life. And then we're going to divide that by its useful life, which we're going to say is 10 years. And that'll give us the depreciation per year. So we're going to divide by 10. That gives us the depreciation per year. However, we are only looking at 1 month's worth of depreciation here. So we're going to take that depreciation per year and divide by 12. And that's the 775. Many problems will just give you the 775 when you're looking at the adjusting process, and you'll have to, of course, work through that calculation if looking at the depreciation type problem. We'll do that one more time. It's calculation right here. It's less easy to see when we don't have these sub calculations, but you can get an idea of what it is here. We're going to say equals, and we're going to take once again that 103,000, and we're going to subtract the salvage, which is 10,000, and then we want to divide it by the number of years, which is 10 years. However, if I just divide it now, because of the order of operations, it will do the division of 10,000 divided by 10 rather than 103 minus 10,000 divided by 10. So we need the brackets. If we're just going to write it linearly, I'm going to put the brackets around here and then divide it by 10. And then that would give us the depreciation for a year, and we need to divide that whole thing by 12. I don't need brackets this time. We could put brackets around here and here, but we don't need it because it'll do this bracketed thing first, and then it'll go from division of the 10 and then division of the 12. So we'll just divide by 12, and that'll give us the 775. So that's the amount we're going to use, and we're going to debit that and credit the same amount. So here's our adjusting journal entry we have recorded here, and we're going to post that to our adjusting worksheet in the middle column. So we will post the depreciation first. Here it is there. Here it is here. We will be in the middle column. We are in cell M26. M26. We will select equals and point to that 775, bringing the balance up from 0 to 775. That will also put us out of balance and bring net income down. So we'll select enter. There it is. We're out of balance by that, and net income is brought down by that. Then we're going to record the second piece, accumulated depreciation. Accumulated depreciation is here. We want to be in cell M. We are in M9. selecting equals and pointing to that 775, bringing the balance up from 0 by 775 to 775. And there we have it. That will put us back in balance down here as well. If we see what is going on, then we can say that we are telling our reader now, this is what we bought it for. This is how much we think it went down in value. And if you subtract those two out, the 103 minus the 775, that gives us 102,225. That then is the book value. That's the book value, the estimated value that we believe this is worth. Note that this is our first contra asset account, so it's an asset account with a credit balance, which is contra to the norm of all the asset accounts that have normal debit balances. And so that will be that. And then, of course, the expense, depreciation expense, related to the allocation of the cost of the equipment over the time period which we believe it will be used. And that, of course, will bring down the net income calculation.